The IMF calls it the largest oil market disruption in history. Central banks are misaligned and fiscal stimulus is already in place across the globe. Bitcoin is closing its sixth consecutive monthly candle in the red. We are at a historic crossroads across energy markets, traditional finance, and crypto. Yes, things are challenging, but there are also some surprising positive signals buried in the data. So the question is, what happens next and how fast? Let's see where we are likely heading. I'm Igor, Investment Director at Venionaire Capital, your entrepreneurial partner, and this is Crypto Insights. Let's start with ETF flows. Last week's US-based spot ETF flows declined further, with both spot Bitcoin and Ether ending the week with net negative outflows. When we take the size of their respective market caps into account, spot Ether ETFs at negative 206 million stand out as much higher net outflows versus Bitcoin's 296 million. So over week for the COT data, commitment of traders data for futures contracts shows in aggregate an increase in net short positioning for commercial traders, which is a cohort of large hedgers. Large speculators are somewhat flat, and smaller retail traders are increased or have increased their net long positioning. So in total, this signals an increase in bearish sentiment and bearish positioning for both BTC and Ether in the interim. But before we dive into the technical picture, we need to understand the macro force that's driving all of this. This week is one of the densest in this quarter when it comes to key US macroeconomic data points being published. The main catalyst, I would say, is on Friday with key labor market data, NFP or so-called non-farm payrolls. But given the broader macro and geopolitical context, any rally in equities, in US equities, due to key data alone would be short-lived. So why does the macro backdrop matter so much right now? Well, the energy supply disruption is already too severe. Around 18 million barrels per day are missing and can be quickly balanced out by any potential restart of supply outputs. The Strait of Hormuz is largely still closed. The normalcy that I would say that was in place before the conflict outbreak is now a thing of the past. Asian production economies and societies are already suffering under energy rationing and scarcity, with governments and major local companies prioritizing critical infrastructure and critical services. The immediate and delayed effects on the USA's and the European consumer economies bring increased persistent inflation and tight liquidity due to rising bond yields. For example, the International Monetary Fund, the IMF, has officially recognized the severity of this current situation. So the IMF is warning that the ongoing conflict in the Middle East is delivering a quote-unquote a global yet asymmetric shock to the world economy, driving higher prices and slower growth. With the ongoing conflict and the Strait of Hormuz largely still closed, the IMF says this could mark the largest oil market disruption in history. So how is Bitcoin behaving in this environment? Bitcoin is at times correlated with US tech equities markets, but it can move on its own for periods of time. Right now, it is not entirely decoupling. Rather, Bitcoin is being I would say, sucked into a broader risk-off move and is following the direction of the broader market. Yet on a relative basis, it shows notable resilience since the conflict started end of February and has outperformed both major US equities and gold during that period, as you can see on this chart right now. As a reminder, Bitcoin and crypto assets entered the current crisis period already weakened after two historical market crashes. So let's look at the technical levels to understand exactly where we stand right now. The BTC power law corridor paints a very clear picture. The lower channel would need to hold, as you can see it here in this chart. So where we currently stand reminds me of the previous few times BTC price visited these lows. The COVID crash, the FTX implosion, and the US-based broader risk-off conditions back in August 2023, very similar to what we have now across the markets. So when we zoom in a bit on this chart, the picture gets a bit clearer. This is also shown on the Pitchfork anchored in early 2023. BTC has already slid out of this Pitchfork's lower band, as you can see on this chart. So the current BTC trend remains in bearish territory, with its price still trapped in the current local range, marked by, let's say, short-lived upswing attempts that have been rejected so far. The same goes for Ether, and we are approaching an important technical milestone. Today we have the monthly and quarterly close coming up. So for Bitcoin, this is shaping up to be its sixth negative monthly close in a row, its second consecutive losing quarter, or in other words, first 3 months losing streak for this year, as we can see here in the table. After having already printed 6 red months in a row, as I've said, Ether is now so far slightly positive, but could easily lose ground and close its 7th month in the row in the red, similarly to Bitcoin's 6 months. We still have more than a third of today's trading session to go before the official close. So if the broader risk-off across legacy markets persists or accelerates, BTC would have a very hard time, let's put it like this, swimming against the current. Can it do that? I mean, sure, it can. How likely is it? In my view, are not likely anytime soon. The best chances for any sustained BTC rally are after TradFi stabilizes and risk-on assets become attractive again. But the TradFi downtrend, as we have it currently, has just started. Here again are the key charts for reference: S&P 500 or SPX, Nasdaq, and the MAX 7 index. They are all trending to the downside and clearly below their 200-day moving averages. Here's what's surprising: despite all of this bearish positioning and macro stress, there is notable relative resilience in crypto assets. Over the past months, Bitcoin, Ether, and few large cap altcoins, altcoin majors, have been holding their lows post the early February crash so far and have shown relative resilience despite the major macro shock and spot ETF outflows that we've seen since late February. So, as a reminder, here is the BTC and Ether chart from the last week, which we discussed in our last episode. Now, let's take a look at where we currently stand. If you observe the lower purple channel line, you'll see that both BTC and Ether are trading outside of it. Bitcoin seems more inclined to revisit the support area around 63,000-62,000 US dollars. It is trading much closer to it right now than is the case with Ether, for example, trading to its February support. So it's not as close. Both are currently not in a position of major strength, especially after multiple failed attempts to break out of this range, local range, to the upside. Both are still in a downtrend and also below their 200 daily moving averages, which is a very good indication of the current prevailing trend. This is seen here in the chart as a yellow line. If Bitcoin and Ether are having a rough time under the current market regime, then broader altcoin markets, as their higher beta assets, are struggling even more so. So we are in a bear market, period. I mean, no signs yet of a trend change. Not for BTC, not for Ether, and not for altcoins. Committing capital prematurely usually gets punished, especially in highly volatile markets such as crypto. So the best case scenario, in my view, for both assets, BTC and Ether, would be to hold their early February lows and remain in the sideways channel rather than slide lower, something we discussed in more detail in last week's episode. There are however, a few exceptions worth noting. Let's say, handful of altcoin exceptions. I mean, quite literally, a handful of altcoin exceptions. For example, Hyperliquid, Morpho, Zero, Sky, Tau, Venice, have done excellent since start of this year and have outperformed Bitcoin and Ether so far. So to put it into perspective, there are literally millions of coins and tokens available on crypto markets. Now, let's check in on what the institutional players are doing. Bitcoin treasuries have slowed their accumulation pace, most notably Saylor's strategy, which reported no purchases for the past week. This is their first pause in 13 weeks. Nevertheless, Strategy is still undisputed number one BTC treasury company worldwide, as you can see on the current graphs. So in this chart, we can see the accumulation pace and the total balance of their BTC holdings. Strategy's stock, MSTR, is trading some 70% below its all-time highs, as you can see on this chart. And like BTC, it would also, at best, just to hold its current lows and drift maybe sideways for some weeks or months. It doesn't seem to be the time yet for any exposure to MSTR stock. Now, Ether treasuries, led by Bitmain holdings, actually continued to grow over the past week. Bitmain is focused on accumulating exclusively Ether, targeting 5% of Ether's total supply. With their latest last week's purchase, they reached 4.73 million Ether coins in their holdings in their treasury, about 3.9% of the total Ether supply. But in the grand scheme of things, Bitmain's stock is down over 70%, similarly to Strategy's MSTR. And ideally, it too would hold its current, or holds its current local support area, let's say, or basis over the coming weeks and months, as you can see in the following charts. So the relative resilience of Bitcoin, Ether, and some alt majors within the overall economic systemic shock implies that crypto markets would bounce back very fast and very hard should a conflict solution emerge. TradFi, on the other hand, would merely be playing catch up to any crypto rally, given the 24/7 markets and highly volatile nature of crypto markets. On the other hand, should the crisis in the Middle East persist, TradFi would continue sliding much lower and thereby undermine any remaining crypto buyer confidence and risk on appetite that is still the reason for holding the current line of defense. So let's see how this week goes. Thank you for watching.